Welcome back. Well, the markets are holding high with a gain of close to around 60 points. Another day, another record high out there. Only today, the worry for me is that the mid-cap index, after outperforming for two sessions, well, that's taken a bit of a break. So the mid-cap index is down close to 0.3%. Let's see whether or not there is some bit of recovery from here on. But one stock that's done very, very well is Ircon International. The stock is up big time. It's up close to 40% actually in the last 1 month. The company also recently emerged as the lowest bidder for around 390 crore construction project at Bhavati Canal. Well, Mr. Yogesh Kumar Mishra, the chairman and managing director of the company, joins us on the show. Hi, Mr. Mishra. Thanks so much for joining in. Well, the street is clearly excited, post your you delivering numbers. And one thing that stood out was the margins. The standalone business margins improved to around 7%. Most on the street were baking in a number of around 5.5%. Do you think that you can hold margins at this year? And also your revenue target for this year was around 9.5 to around 10,000 crores odd. Do you stick by that or do you want to up that? Go ahead.
Yeah, I think thank you so much. Considering that, and for these two quarters are most difficult for any infrastructure company because of the rains, festival season, and also there was a volatility in the commodity prices. Still, we have managed to do well and, managed to get good set of both revenue as well as margins. We are pretty confident that we'll be able to maintain these margins, in the coming quarters. And the revenue targets that we had given, about 25 to 30% more than last year, which is around 9,500 to 10,000 crores, is what we expect to achieve during the entire year. And maintaining our margins. So I think we are pretty confident about that.
Margins, so just to clarify, standalone margins were around 7%. So you're going to maintain that, right?
Yes, exactly.
Got it.
Morning, this is Rima here. Just wanted to get a sense on the ordering from here on. Your order book is roughly 40,000 crore rupees. Last year, the order inflows were 15,000 crore rupees. But in the first half of the year, the order inflows was just 331 crores. Very, very muted. And you've indicated that you've gone slow, purposely because you wanted to focus on kick-starting the orders that you'd won previously. But could you give us a sense that what is the order inflow we should expect in the second half of the year?
Yes, Rima, I think you guessed it right. We secured a lot of orders in the last year, about 15,000 crores. In fact, in the last 5 years, we have doubled our order book from 22 to 44,000 crores. And as you can see from the orders that we secured last year, we have moved into many new sectors like the high-speed rail, like the solar projects. So there, we needed some time to really develop our execution capabilities. These are new areas for us and obtain confidence before venturing into new projects in these areas or in some other areas. So that's why this first 6 months has been muted in terms of order inflow. We are now looking at sizable business opportunities which are coming up as EPC contracts, both in the railway sector and the highway sector. And we are planning to bid now for some big ticket projects, and we hope to secure some of them. We have bid in some foreign projects as well, and but we were not very lucky to get one of them.
Mr. Sorry.
Do you think FY23 order inflow can exceed FY22 order inflows because you are now aggressively bidding?
No, I said we are not aggressively bidding. We are looking to maintain our margins. So so after this consolidation that is happening in the first 6 months, we will now gradually increase, trying to get more projects in the next 6 months. But then it is, I'm doubtful that we'll be able to secure as much projects as we did last year. But we definitely are looking at securing maybe 5,000-6,000 crores worth of orders at least in the next 6 months.
Okay. Mr. Mishra, hi, good morning. This is, what's the split between government and private projects, sir, in your order book?
No, we don't work for private contracts, but what I can tell you is we have nomination projects and we have bid out contracts.
Correct.
Right now, our mix is in the about 50-50. So now we have about 50% projects which are bid out, in the competitive bidding, and 50% nomination, because the Ministry of Railways has stopped giving us works on nomination. So we have now picked a fair share of the projects from the market, and still we have been able to maintain our margins. So that way, I think our performance has been really good.
Right. And why is that? Why is the Ministry, is this a policy decision? Nomination work is stopped, you said?
Yes, it's a policy decision for all the PSUs,
Everybody.
not just for everybody.
So generally, I mean, I'm assuming that nomination work margins would be higher, right? I mean, if you're bidding, you'd have...
No. I think the nomination margins, in fact, were limited margins. So there was a cap on the total, the total margin that you would get. In a competitive environment, depending on the type of project, type of work, depending on how much competition is there and how good you are in working out the costs, you can have, in fact, better margins in some projects. And we are also bidding for now consultancy contracts, which typically have a much higher margin in the range of 15-20%. So we will have a mix of that also to improve our overall margins.
Okay, all right. Mr. Mishra, the takeaway that I'm getting is you're confident on maintaining margins, and also you're not bidding aggressively, but your focus is also on margins, which is spelling good news in the years to come. My question to you is, your order book is looking great at more than 40,000 crores. Do you want to give us a guidance for FY24? How are things likely to shape up? The order book is there. Now it's all on the execution. So a rough number out there?
I think next year also our revenue should be maybe it will be better than this year, but not so much. Maybe not in the range of 25 to 30%. But definitely we will be either able to maintain these revenues also, or increase it by 5 to 10% based on whatever orders we have right now. And I think all our projects are in execution stage. They are all doing well. So so we will be able to, I think, maintain that.
You're saying revenue growth for the next year is around 5 to 10% as of now. You could revise the number. And final question, sir, what about monetization of the road or other assets? That's a trigger that the stock market is looking at. Any rough number or timeline that you could give us?
No, monetization of assets is a long process. We have just started, exploring the options available to us, and this is not something that we can decide on our own. We have to get approvals from the ministry, DPAM. So, but we have started exploring, our what is the valuation of our assets, what is it that we can really realize, and then based on the guidance of the ministry, I think we will take a call on that.
You said you're exploring consulting orders where the margins are significantly higher, 15 to 20%. How big is the opportunity according to you for you?
No, in terms of revenue, it is smaller. The revenues that you realize from consultancy projects are smaller. So, but then, even if I am able to secure 100 crores, and I am able to get about 20-30 crores on that, in terms of percentage, it becomes much better. So right now, the consultancy contracts, that we target is about, say, 500 crores. So maybe that could result in a revenue of, margins of about 75 to 100 crores.
All right, fair enough. Mr. Mishra, great speaking with you, sir. Appreciate you joining us and running us through, all of that. A lot of detail coming through on IRCON. Margins is the focus, and there are levers like consulting orders, which are high margin, 15-20% kind of margins, which can provide some fill-up. Stocks have done exceedingly well. IRCON has done well, RVNL has done well, IRFC, and so many others in that space. On to our special segment, Charting Trends now. Rahul Sharma is Head of Technicals and Derivatives Research at JM Financial Services. He's with us here in the studios. Rahul, great to have you with us here. Thanks very much. New highs on the Nifty, so I guess one has to start with that. How do you kind of project higher levels once the index is at higher levels, and how's it looking for the Nifty from here?
Yeah, first of all, thanks for having me. This is my debut in your studio, so feels good to meet each one of you in person. Coming to, at 18,600, the risk reward definitely is not in favor of large caps as we speak. And incrementally, what has happened is the risk reward in the laggards. So first we saw the Bank Nifty hitting life highs, followed by Nifty. I think the pockets of the market where there is a lot of catch up to be done. One is the mid cap space, another is the small cap space. So I think that becomes more attractive, more lucrative at lifetime high levels. Yes, markets may continue to do good from here, but as far as the big money is concerned, I think that is where the alpha can be generated in the near to medium term.
That is mid caps and
definitely mid and small caps. So if we talk of numbers, the mid cap 100 index is approximately 6% away from lifetime highs. The small cap index is around 8 to 9% away from lifetime highs. So just a catch up rally. Historically, these indices have outperformed the markets in bull phases.
Yeah.
So even if we have to play catch up, so first the catch up and then the outperformance. So that can simply translate into anywhere from 20 to 25% return in the next few months down the line.
Okay. All right. Hi, Rahul. Good morning and good to meet you in person as well. I think you got that bang on, right, with regard to the client versus FI positioning. And you said you're going with the clients. They have got it right and bang on, it did play out. My question to you is on the index itself. Do you believe that 19,000 is on the cards for the December series? Is that a possibility? But you look to get in on a dip. What's the entry point?
Yeah, so, there was a point in time where FIs were heavily short on the market and retail, just got it right. It has been the norm since last 12 months now. Yesterday was the first time when, retail went short on the index versus FIs, which are still long. So what is happening is essentially, the retail is losing interest in the large caps or, vis-a-vis, the broader market. So what is now happening is there is a good chance that Nifty continues to do well because nobody is really short on the market. There's no heavy shorts in the system. So we've seen this low IV. Nobody majorly short or long on the market. Historically, last year July 21, markets went nowhere. So I think this is one of those phases where we may see subtle movements. Not big gap ups, gap downs. Markets may just consolidate with a positive bias. So yes, 19,000 is very much on the cards, but it's just that it may not happen with the same gusto and energy that we saw in the first leg of this rally.
Okay, can you give us some sectoral flavor? Where is it that you think leadership could come through? Money is chasing which sectors and stocks?
Yeah, so you have to look at it from technically speaking. If you're chasing momentum, I think it has to be the PSE pack. Public sector enterprises. This is one index which is at decadal breakouts. The returns could be anywhere, from 20 to 25% in the next 6 months or so. So it is at a cusp of a big breakout. If you are looking for reversal play, I think small caps and mid caps are one sector that can do well. I think in the banking pack, there is a shift that is happening. PSU banks have done their bit. I think it's a good time to take profits and move to private banks. Private banks historically have led the banking pack. I think that ratio between private to PSU is about to tilt.
Yeah, no, let's just have that graphic up which we put out, the story of sectors. I think Rahul, you send this and just explain what you want to say. Are you that's the one, you can see it on the screen. Are you talking about the rotation from one sector to the other? I mean, different sectors doing well in different phases, different time periods. Just talk to us about this.
Yeah, absolutely. So, looking at this graph, it is the red line that you can see right at the bottom is the IT index.
Okay.
So, from a headroom perspective, IT is one space which can deliver, the maximum potential returns if you are an investor.
Okay.
The yellow line is the one which is the pharma, which has been a laggard. So these are, primarily the only two components in the Nifty 50 space which have, properly underperformed the Nifty. And these two comprise of, so IT is around 10%, 6% is from the pharma. So around 16% of Nifty is underperforming. Out of the rest of the pack, I think the gray line, which is right at the top, is the PSE. So if you are a momentum chaser, and plus this is coming out from decadal, underperformance. So this is where, the big momentum guys can, cash in and, make big money. In between, you have the small caps and the mid caps. So, if you have like a 3-month perspective, mid and small cap should be the flavor of the town. Yeah. And if you have like a, slightly, bigger money, bigger time frame perspective, PSE is one sector to play with.
Well, Rahul, the sense you're giving us is the broader markets, maybe there's a bit of a catch up that's due. So let's get to a couple of stocks then. Which are the ones that are looking good and what kind of allocation would you give them from the broader markets?
Yeah, so in fact, we have, identified a list of stocks, especially from the large cap space, which mid-cap space which can be bought at these levels. 5 names, 5 of the best setups. One is Aditya Birla Fashion Retail. This stock was a very good performer in this calendar year. This correction, recent correction, which has come off from 350 odd levels to 300 odd, makes it very attractive at these prices. Then from the PSU pack, which is the flavor of the market as of now, Concord looks like a very formidable bet at these levels. You have Poonawalla FinCorp from the NBFC space, which is also poised well. And from the castings and forging business, Bharat Forge is something that is coming out of multi-month consolidation. So this stock has another, possibly another 20% upside from these levels. And because IT has so much of headroom, why not have a mid-cap IT stock as well? So Coforge remains our top pick from the mid-cap IT space. So looking at the basket, we are looking at an upside of anywhere from 20 to 25% in the next 3 to 4 months. These stocks can deliver that kind of a return. And you could have a portfolio level stop loss at maybe 10% of the total investment value. And we feel that 6% catch up of mid-cap index to previous life highs should easily translate to at least 10 to 12% return on these stocks. And from there on, I think these stocks should take off. There is cold money and there is hot money. I think this is the time where hot money will come back into these stocks, and we'll see those frenzied return that we've seen in the past come back to these kind of stocks.
These are stocks which are off their earlier highs, right? So this is not, so you're not buying newer highs when you say that these are the five of your picks. So you're looking for turns, basically, turns higher, longer term setups, etc. But you're not chasing momentum here. At least not right now, with these names.
Yeah, so absolutely, because the mid-cap index has been an underperformer, it's, most of the stocks are actually reversal candidates than, momentum chasers. So even if they have to, attain their previous size at a good amount of, headroom on the upside, the second basket, which looks even more attractive in terms of, percentage returns, is the small cap basket. So small cap 100 index, a small cap 250 index is like 9% away from his previous lifetime highs. Some of the names, for example, sugar is on the verge of a big reversal. Balrampur Chini remains our topic from the sugar space. 7 months of underperformance now, getting converted into a big reversal. Yes. Then you have Angel One. So obviously markets at all-time high. Our industry is something that will benefit from larger volumes and greater market share. So Angel One is another setup which looks very good. From the defense space, Bharat Dynamics, we've been recommending this stock since many months now. This continues to be our top pick in the small cap space. So Bharat Dynamics looks good for another 20% upside from these levels. And because private banks are doing well, I think City Union Bank is one small cap bank which can deliver a punch from here. So we are looking at approximately a 25 to 30% upside in City Union Bank from these levels. And because it is winter, because we've seen tourism at its peak, Delta Corp is one stock which can see formidable upside from these levels. So this basket is looking even more attractive. Possibly a 30 to 35% return is possible in this basket. And the reason why we only chosen 5 stocks is we want concentration to be at play here. So top 5 mid caps, top 5 small caps, and I think this is one meaty part of the market which can pack a punch in the coming 3 to 4 months.
Let's turn our attention now to the commodity markets. Manisha is waiting by. Manisha, what's the one commodity that you're tracking?
Nima, thank you so much. I'm looking at the rubber prices because this has been 1 quarter and 1 year rather when we have seen the rubber prices continue to decline. So today as well in the international markets, we have started with weak cues. We're trading at a 2-year lows into the markets there. The concerns clearly coming in from the global recession fears, and the demand on ground continues to be on the weaker side as well. Supply chain restrictions, COVID restrictions that is, and supply chain issues have been other factors. And mind you, this is also the peak arrival season, tapping season as well. And as more and more natural rubber comes into the market, the takers are far and few. This is also the time that you see quality buying happening into the market, because it is around the peak tapping season is when most of the quality rubber is taken in by the stockists, but that number also is slightly on the weaker side here. The markets are looking at more and more tire makers and automakers continue to give lower guidance going forward. The latest has been Toyota, which says that in Japan in FY23 they're looking at lower production on a year-on-year basis. That clearly is weighing onto the markets today. Also, when you look at the prices prices itself, the high, that is where we started this year, was $185 per kg. Low has been 117, as we are trading near those lows at this point in time. So near 2-year lows is where we continue to trade in the international markets there. Take a look at the global production numbers then, and we have seen constant increase into that one on year basis, even as consumption in a couple of years has been on the weaker side. But as you can see on your screens, the global production numbers have continued to increase up. That is not where the demand seems to be keeping pace with. When you look at the consumption numbers there, 2021 was an year which was catching up, because 2020 was a very weak year, is the reason that you have a big double-digit number coming in there. But even as 2022 estimates are at 1.9%, markets do not believe a big gain over onto that. It's just about 2.8% of a run-up that you are expecting in next year as well. So the demand estimates continue to be on the weaker side, production increases, and that could keep rubber prices under pressure.
Okay, all right, Manisha, thanks a lot for that. Well, it's that time of the day when we focus on a few stocks that are doing well in the first hour of trade, and Lupin makes it to the list. Ekta joins us to tell us about the brands that they bought, and some of those brokerages are in those. Ekta?
Thanks for that. Well, yes, there is additional piece of news which has come in for Lupin besides some brokerage notes. I'll get to that in just a minute. The news is that their subsidiary in Brazil, in fact, has signed an agreement to acquire 9 medicines from Bosch Health. Now, the market share for Lupin is around 4% in Brazil in FY22. It is a part of their growth markets, which is around 10 to 11% of their sales. And the growth markets itself, which is basically Latin America as well as Asia Pacific, has been doing quite well. It's up around 27.5% on a year-on-year basis in Q2 itself. While the amount is not disclosed, it is expected to aid the entire product portfolio that they have in the Brazilian market. Separately, Antique has upgraded Lupin to buy versus hold with a target price of 850 rupees. According to them, the US revenue growth is expected to improve sequentially Q1 FY24 onwards. This is due to the impending launch of Spiriva generic as well as the biosimilar for cancer pegfilgrastim. Estimated EBITDA margins are at 16% for FY24 according to Antique, and 18.5% for FY25. Remember, this is the second positive brokerage note just released in the past couple of days for Lupin. On the 23rd of November, Citi had written on Lupin. They had a buy with a target price which was raised to 840. According to them, Spiriva generic, which is basically the impending launch, is an inhaler. If it is approved, the product has the potential to repair margins from sub 10% to 17 to 18%. And they believe that the downside is limited because of a strong flu season in the US for Lupin in any case.
All right, Ekta, thanks very much for that. Lupin in focus. Well, let's revisit the brokerage, the standout brokerage report of the day with Nimish. He's standing by. Nimish, over to you.
Hi, Prashant. So today's standout was in Laurus Labs, and a sharp knock on that stock. It's down 6% after Kotak Institutional Equities downgraded the stock to sell, and they've sharply cut the target price to 350 versus 460 earlier. Now, Kotak believes that companies' AVR pricing and looming cessation of Paxlovid sales are being underappreciated. In fact, ex of Paxlovid, Laurus reported just 19% EBITDA margins in first half of FY23. Even as volume picks up, Kotak believes that the AVR realizations will be under pressure, and as Paxlovid sales recede, the true extent of margin hit will unravel, and hence they've cut the EPS estimate by 12 to 28% between FY23 and FY25, and they've cut the target price in Laurus 350 now versus 460 earlier.
Nimesh, thank you very much for that. And finally, it's Paytm on our radar. Surbhi is here to tell us more about the CLSA upgrade on Paytm. Surbhi?
Thanks for that. Paytm has been in focus today, and that is because CLSA has upgraded their rating on the stock from sell to a buy with a target price of 650. That gives it a potential upside of nearly 40% from the current market levels. They say that there has been substantial price correction in the stock in the past 2 weeks, and that makes the risk reward more favorable. The company has more than $1 billion of cash in the balance sheet, and according to them, the cash burn should end in the next 4 to 6 quarters. The net take has also improved 13 basis points, but fixed cost absorption continues to be a concern. According to them, even a 10% reduction in fixed costs could result in a 27% plus EBITDA upgrade. Additionally, they say that the revenue growth drivers for the next 5 years will come from loan and credit card distribution. As per them, Paytm trades at 16 times FY26 EV by core EBITDA multiple, which is at a 25 to 40% discount to Aiden and blocks their international competitors' EV EBITDA multiples.
All right, thanks very much. By the way, Paytm was up 4%. It's come off a little bit, 2.5%, 3% now, 473 on that one. The index is up 60 points, so it's holding very, very well. We'll take a quick break here. On the other side, our special segment, it's the economy. My colleague Lata will get chatting with Jitana Khandari of Morgan Stanley to discuss in detail about the